Hi, welcome back. In this, the third in a series of posts I have on how investors and traders react very differently to earnings reports, I'd like to focus on two more very high profile companies, Amazon and Netflix. Well, part of the allure of these stocks is how well these stocks have done, especially over the last 2 years. Last year, for instance, while the market was flat, these stocks were up almost 30% apiece. But it's more than what they've done in terms of their market capitalizations. These are two companies that really give meaning to the word disruption, a vastly overused word from my perspective, but a word that's fitting when you think about these two companies. Amazon, of course, has disrupted the retail business. It's changed the entire business and perhaps laid the traditional business to waste. And it's not stopped there. It's moved on. It's now part of the media business and the cloud computing business, and it's doing to those businesses what it did with the retail business. Netflix has changed the entertainment business. It started off as a DVD rental outfit and has increasingly become the place to go if you want to watch movies and TVs. In fact, the growth of these two companies is best illustrated by comparing them to status quo companies, large traditional companies in each of the businesses. In these two graphs, I first compare Netflix to Time Warner, large entertainment company with a big footprint. And guess what? Netflix has progressively grown over the last decade to be almost 60% of Time Warner's value. Amazon's growth relative to the giant in the retail business, which is Walmart, is even more striking. Amazon has exploded out of the box to become larger than Walmart in terms of market cap. Now, for many people, that's the end of the story. They look at these numbers and say, there's no way. There's no way an Amazon could be worth more than Walmart. There's no way a Netflix can be worth 60% of what a Time Warner is. And maybe they're right, but maybe they're wrong. I don't think it's that simple. You cannot make judgments on whether a company is worth a lot just by looking at how old it is or how much its revenues are. I think you have to look at the future of these companies, and that is what I hope to do in this particular session. So let's start with Amazon. In its most recent earnings report on January 28th of 2016, Amazon came out with numbers that did not quite match expectations. It actually delivered earnings of $1, which was a surprise because this is a company that historically has delivered losses, and for the third quarter in a row, it reported profits. And therein lies a story that I'll come back to. Its revenues came in slightly below expectations, and because I guess expectations were so high, the stock price collapsed after the announcement. It dropped almost 15%. To give you some perspective, that's almost $45 billion in value lost on one day. So the earnings report was not well received by the market, and it's not quite clear what in the earnings report, other than the earnings per share, was so surprising to analysts and investors. Now, looking at that same earnings report as an investor in Amazon and one who's been very interested in this company going back to 1998, which is the first time I ever valued the company, I didn't see much in this report that changes my perspective on the company. I've always described Amazon as a Field of Dreams company. Remember Field of Dreams? It's the movie where Ray Kinsella builds a baseball field in the middle of Iowa. And he says, if I build it, they will come. Talking, of course, about Shoeless Joe Jackson and those mythical baseball players who come out of the cornfield at the end of the movie. Amazon's variation on this theme is their argument has always been, and Jeff Bezos has been very clear about it, going back to the very first newsletter that he sent out to its investors in 97. His focus has always been, we'll build up revenues and they will come, they of course being profits. He has been so remarkably consistent in telling the story and delivering numbers that back up the story that the market has given him an incredibly long time period to deliver on earnings. Now, if you look at the earnings report, it delivers more of the same. It delivers revenue growth of 20%, astonishing when you think about the fact that Amazon started off with $88 billion in revenues. This isn't a small company. Its earnings were lower than expected, but I find it striking that for the third quarter in a row, the company reported positive earnings. In fact, there were news stories that came out during the course of the quarter that suggest to me that Amazon is in fact turning its attention to profits. News stories like what? Like the fact that they laid off employees who were working on the Amazon Fire because they were not delivering a product that could actually make Amazon any money. I'm not suggesting that Amazon is going to give up its focus on revenues anytime soon. But I have a feeling that the other half of the vision, the idea that profits will come, it's starting to deliver on. So my updated story for Amazon is still that it's a field of dreams company, but perhaps the dreams are getting a little closer to actually happening, to turning to reality. So in my story, all that's happening is the company is moving a little closer to the day where it can try to use its market power to deliver earnings. Now, to value Amazon, I made some assumptions. And the assumptions I made reflect my story. I let Amazon continue to grow revenues at 15% a year for the next 5 years. If that seems like a big drop off, I'm essentially letting Amazon's revenues go from 100 billion to more than 300 billion over the next decade. That's a pretty large increase in revenues. I also assume that Amazon will keep working on its profit margins. In fact, while traditional profit margins have been low on Amazon, one reason they've been low is because Amazon spends a huge amount of money on technology and content. It's equivalent of R&D, $12.5 billion just in 2015. If you treat that as a capital expenditure, which I think you should, and give it a short life, which I think is appropriate, Amazon's profit margin increases not to a huge number, but to a not bad 6.58%. I think that profit margin will continue to improve. To what? I use the weighted average operating margin, pre-tax, of three businesses. The retail business, where Amazon is a big player, 73% of its revenues come from retailing. The media business, where Amazon is an increasingly large player. And the cloud computing business. That average margin of 8.8% becomes my target margin, and that is asking for a lot to triple your revenues and increase your margins, but I think Amazon has a shot at doing this. Based on those assumptions, the value that I get for Amazon is about $323 per share. That's a pretty large value, but it's still well below the stock price of $507. In fact, if you look at the $507 stock price, and given the uncertainty about future outcomes, there's still a reasonable chance that Amazon could be worth more than $507, but there's a much, much larger chance that it's overvalued or overpriced at $507. So that's my Amazon pitch. I'm not sure how it'll work out, but let's set it to the side and turn to Netflix. Netflix, in its last earnings report, reported much better numbers than expected, with two quirks. One was the fact that its expenses grew, but its expenses grew because it's producing more of its own content. So there was a signal that they're moving away from acquired content, which has been their traditional model for delivering content to their subscribers, to making their own content. So that's increasing costs. So that trend came through. The other was that while their domestic subscriber growth was less than expected, their international subscriber growth was higher than expected. Before you get too excited though, those international subscribers are actually losing Netflix money right now, but it's clear that the company is getting more global and turning to more original programming. Initially, the market looked at the numbers and was impressed. And the price jumped almost 10% in the announcement, but it very quickly gave back almost the entire 10% after people had a chance to look at the numbers more closely. So traders overall were not that impressed with the earnings report. Now, looking at Netflix as an investor, let me tell you the story I had for Netflix before the earnings report. I've always viewed Netflix as a content delivery mechanism. It uses the subscription model where you and I'm a Netflix subscriber, pay $10.95 a month, $8.95, $9.95, depending on where you live in the world. It collects those subscription revenues, and in return, we get access to Netflix's library. But how does Netflix get that library? All those movies and TV shows that you get. Historically, Netflix has acquired this content from the studios and has agreed to pay the studios not just money this year, but in the years to come. In fact, if you look at Netflix's financial statements, in the footnotes, they reveal their commitments, their contractual commitments on content, how much they have to pay. I'm going to come back and talk about that in my valuation, but that has been their traditional model, to buy content and deliver it to subscribers in return for a monthly fee. What this earnings report suggests is that while that model continues, there are small changes in the model. The first is Netflix is increasingly shifting its attention to the foreign market because the US market is fairly saturated. The second is increasingly Netflix is going to start producing original content, which is a different business than acquiring content. It comes with its own pluses and minuses. So my new story for Netflix is it'll still be a subscription-based company with more original content than it used to have and more of a global focus. Now, in valuing Netflix, I did make some adjustments to the accounting numbers. In particular, I think Netflix is an immensely profitable company if you treat its content as the equivalent of content that's acquired with debt. If you capitalize it in a sense. So if you do that, the value that I get for Netflix, reflecting those much higher margins, is I change my perspective on the company. The traditional view of Netflix is a company which doesn't reinvest very much and doesn't make much money. My perspective is different. I think Netflix is a profitable company, an immensely profitable company that reinvests a lot, perhaps too much to get its content. It's trying to get that investment under control. With the assumptions I made for Netflix, which is basically that it'll continue to grow its revenues and continue to work on its margin, though that margin will start to decline. Remember, I've capitalized the content cost. So the margins that I have for Netflix are in fact pretty high. Will start to move towards a margin of an original content movie company. Still pretty healthy margins. The value per share that I get for Netflix is about $61. Again, much lower than the 86, but again, because there's so much uncertainty about the future, it is entirely possible. In fact, there's about a 15 to 20% chance that Netflix would be worth more than $86. So I'm not going to argue with you if you say Netflix is worth more. It's your story and your investment, but from my perspective, it looks overvalued. Now, Netflix and Amazon are to me litmus tests on whether you're a trader or an investor. Remember in the very first post, I posed this question to you. I said, are you a trader or you're an investor? What's the difference? An investor plays the value game. He or she values a company, compares it to the price. The value is greater than the price. He buys the stock. If it's not, he either doesn't buy the stock, or if he feels strongly, actually sells short on the stock, and he waits for the price to adjust to the value. What does a trader do? He buys at a price and sells at a higher price, or he sells short at a price and covers at a much lower price. Now, most people, if you ask them, will give you an answer. I'm a trader or I'm an investor. And a lot more people call themselves investors than traders. And to me, the ultimate test of whether you're an investor is whether you pass the Amazon Netflix test. What is that test? Most conventional valuation models have shown Amazon and Netflix to be overvalued for much of the last 3 years. That's true of a valuation I did of Amazon in October of 2014. I concluded that Amazon was overvalued at its then prevailing price of $300 per share. I chose not to buy the stock. Guess what it did over the next year? It doubled in price. I'd be lying if I didn't tell you that I had second thoughts, that I did not go back and revisit my valuation. I did, but finally I came to peace with the fact that I'm an investor and I, for better or worse, have to stick with the valuation that I've done. And at least based on my valuations, neither Amazon nor Netflix look like good investments to me now. Does that mean that they will drop in price over the next year? I have absolutely no idea. In fact, I would not be surprised to see them double in price again. Will I feel any regrets? Absolutely not. I'm not a trader. I've never been a trader. I've never been good as a trader. And if I play a game that I did not come to play, the trading game, I'm asking for trouble. So if you bought Amazon or Netflix, I hope you've done it for the right reasons. And even more, I hope you make money. I wish you the best. Thank you very much for listening.